Welcome everybody. In this video, we are just introducing a course on a guide to trade finance and international business. The course will run to 7 to 10 videos and we will introduce the various modules that we cover in this series of sessions covering international trade and cross-border business, how we manage and what are the various trade finance risks, products, mitigants, etc. that helps in global trade. In the first module, we talk about the relationship between trade and trade finance. It's an intertwined relationship because trade finance is the lifeblood that makes cross-border trade happen. The buyer, the seller, and the goods alone is enough for trade. But for trade to happen, you need banking, insurance, logistics, and other services. So the overall commerce runs as a well-oiled machinery only with the help of financial institutions providing trade finance. The institutions have various instruments and services that play a crucial role in bridging the gap and mitigating the risks between the buyer and seller, the importer and exporter. It is a synergistic loop. What is synergy? The sum of the total and the overall whole. There is a large difference and the whole is larger than the sum of the individual parts. It is a symbiotic relationship. The flow or the movement of the goods between the buyer and seller, the exporter and importer, stimulates the need for trade finance. The finance made available by institutions makes the trade smooth and efficient. It facilitates the relationship between the buyer and the seller. In module 2, we talk about introduction to trade finance. Trade finance is the range of products or services offered by financial institutions, including banks, and these are designed to manage the risk that is part and parcel of a cross-border trade. It facilitates the flow of goods in the international trade by giving comfort to the buyer and seller. The trade finance involves instruments like documentary credits, documentary collections, guarantees, and other trade loans, buyer financing or seller financing. Also, it includes supply chain finance, export credit agency confirmations, etc. These are to mitigate the various financial risks and they provide working capital for smooth flow of trade. Trade finance facilitates cross-border trade because cross-border trade is more risky than a domestic trade. These instruments or the services provided by the bank support and manage the payment risks and offer finance for the various stages to the buyers and sellers. What is trade? Trade is the exchange of goods and services. The exporter sends the goods, the importer sends the payment. But in a sense, this exchange of goods or services between two parties can happen only with the help of other agencies like bank, insurance, transport, logistics, warehouse, etc. Typically, across geographical borders, if the trade happens, it is called international trade. It is a foundation of the global commerce or global economy because every country is today interdependent with one another. It helps in development of the nations because without trade, high value goods produced in developed nations will not be available in third world countries. What facilitates global interdependence? The trade allows countries to specialize in producing certain goods or services where there is a comparative cost advantage. This results in better efficiency, better productivity. This interdependence among the nations fuels innovation. It creates new markets for people who are innovative and it contributes to global economic growth. In module 4, we talk about what are the risks in the cross-border trade. One is a payment risk that the importer may fail to pay the exporter. This can be due to various factors. Could be political, could be liquidity, could be FX non-availability, Could be hundreds of reasons, not just bankruptcy or insolvency. Then there is a delivery risk. It's a risk that the goods may not be delivered to the importer by the exporter on the agreed time or on the agreed quality or on the agreed quantity, etc. This can rise due to factors from transportation delays or damages or non-availability of cold chain or warehouse and other customs regulation related issues. The credit risk is that the importer may not be able to fulfill his financial obligation to pay for the purchases to the exporter. This can be solved by having a letter of credit from a bank. So basically, this risk is the risk of creditworthiness or the financial history of the buyer. Then comes the political risk. It's the instability or changes in the policies of the government or the regulations that govern the trade, a particular sector or a particular product or a service. This can include changes in the import or export regulation or the tariffs or the quotas or free trade agreements or other non-tariff barriers. In module 5, we talk about the working capital management for trade finance. Trade finance solutions provide working capital to the businesses. Trade finance services and products enable the operations of cross-border trade. It also helps in managing the cash flow because when you sell, you have a receivable. It may come at sight or it may come after 90-180 days. Likewise, when you buy at sight, you have to immediately pay. Sometimes you pay in advance and sometimes you may have 90 to 180 day credit period. So, trade finance helps to bridge the gap in the cash flows. Trade finance instruments can also facilitate financing raw material inventory or finished goods inventory. Trade finance instrument can also finance the payables or the receivables. By providing access to finance, by providing access to working capital, by making available finance for trade, the products and solutions of a bank or a financial institution enables the business to expand their operations to unknown territories, into unknown geographies, into unknown markets. This empowers them to invest in opportunities to grow their market share. In module 6, we see how companies settle their cross-border commercial activity. That is, what are the various settlement methods adopted in an international trade. The simplest scenario is importer pays the exporter directly. It could be a simple wire transfer. This is efficient, but it has its own risks. To mitigate this risk, a letter of credit can be used. So a bank has to issue an instrument which is a promise that if certain conditions are met, certain documents are submitted, and if found compliant, the bank will pay. It is a guarantee for the payment to the exporter. Then comes a commonly used instrument is a documentary collection, where it can be DA or DP, documents against payment or documents against acceptance. The bank acts as an intermediary. The bank collects the documents and then collects the payments and gives the documents to the importer. For complex business transactions, you can have a bank guarantee or a standby LC. You can also have funding in the form of buyer financing or seller financing. These are the various ways in which money is borrowed or money is arranged by the buyer to pay the seller in an international trade. In module 7, we talk about the various documents used in international trade. If it is a letter of credit itself is an instrument to pay, like a guarantee or a standby LC. Then under the letter of credit, you may have documents like commercial invoice, which is evidence of sale, bill of lading, which is evidence of movement of goods, or airway bill, and then you have a packing list, which will say in which container, in which carton, in what form the goods are being packed or delivered, and then comes a certificate of origin, which talks about where the goods were made. In module 8, we talk about trade finance solution sets. What is that? What are the different instruments that are available from a bank to a buyer or a seller to manage the trade finance risks? One is letters of credit. This ensures payment to the exporter upon presentation of specific documents. Documentary collections. The documents are presented by the bank to the importer asking for payment in return or acceptance in return. Then comes the trade loans, where loans are provided to the exporter and importer to finance their trade finance transaction based on the underlying trade, based on cost of purchase or cost of goods sold, finance is made available. Then comes the bank guarantees or a standby, which is issued to serve as a collateral, as a standby, not as a primary payment but as a support for the underlying transaction or the underlying agreement. This is an assurance that if other party fails, the party can claim from the issuing bank. In module 9, we talk about trade market infrastructure. We talk about what the banks, other government agencies like EXIM or ECA, customs, the buyers and sellers, and insurers, what is their interplay, how the transport, logistics, and warehouse companies facilitate trade. So, this is how this course has been structured. Welcome and enjoy the videos.